Does the UK now have a wealth tax? A wealth tax is a tax that is levied on the size of your assets every year, and you need to pay it simply for the pleasure of holding the assets, even if you don't do anything like buying or selling. Some European countries have wealth taxes, but the UK officially doesn't at this point. However, with recent tax changes, I'm here to tell you the UK actually does have an unofficial wealth tax. In this video, I'll show you what it is and what you potentially can do about it. Hi, I'm Adam Walkham, financial planner, entrepreneur, and author of Plan for Happy. I have built a very successful financial planning business, helping my clients take the worry out of achieving a successful retirement. And now I want to help you do the same. When I say the words wealth tax, most people recoil with fear. A wealth tax is a particularly miserly kind of tax that levies tax on individuals simply for having a certain level of wealth. The most recent politician to suggest a wealth tax was Jeremy Corbyn when he was leader of the Labour Party. And we all know how that ended up for him. In 1990, around 12 European countries had a wealth tax, but interestingly, by 2021, that number had reduced to 5. France, the Netherlands, Norway, Spain, and Switzerland. The main criticism of a wealth tax is twofold. Number one, it's really hard to design. What do you actually include? Do you include someone's main house? But what if they have a mortgage? Do you include pensions, business assets, international assets? The list goes on. Number two, it is really hard to implement and monitor. For example, who determines the valuations of private businesses or property? Those assets are actually really hard to value, so who decides that value? It is simply a minefield to design some sort of policy and will no doubt end up with significant unfair situations and loopholes. All in all, it's not a great tax. But saying this, we actually are in the situation right now where the UK, in effect, has its own wealth tax. Let me explain. You may know that the capital gains tax allowance, this is the amount of capital gains you can make each year before you need to pay tax, has been cut over the last few years. It has come down from above £12,000 profit per person per year to £6,000 last year and is now just £3,000 this tax year. So for any profit you make above £3,000, you will need to pay 20% tax. Higher if it's a rental property, lower if you're a basic rate taxpayer. The issue with bringing the allowance down to such a low level is that it brings a lot more people into the fold of paying that tax, even if they're not actively buying and selling investments. Here's an example. Say you've got £200,000 in a normal taxable investment account, and you've had it in this account for a while, and you are fortunate enough that it has doubled from the original £100,000 you invested. So this means you're sitting with £100,000 in gains. If you were to move £20,000 of this money into an ISA to be tax efficient, which is generally a smart idea, this would crystallise a gain of £10,000, well above the £3,000 allowance, and you would pay 20% tax on £7,000, so a tax of £1,400, all for just trying to be tax efficient. Ouch. Also, even if you didn't do this, you may be paying charges to both an investment platform and a financial planner like me. If these charges came in at say 1% per year, that's £2,000 per year, which is just under the limit. However, most platforms will want you to have more than this in cash on hand in the account, so may sell down a larger portion of your investments to fund that. If they sell down £6,000 to fund the cash, this will crystallise £3,000 in profits and already put you at the CGT limit, merely just for having the account. Anyone with over £200,000 in a taxable investment account has a very high likelihood of needing to pay capital gains tax, or CGT, every year. This is what I mean by a wealth tax. It may not apply to you watching, but actually this does apply to a lot of people out there. So what can you do about it? Not much, to be honest. It still makes sense to contribute to use your ISA allowance in most situations, so best to pay the small amount of tax to get your money protected from future tax in ISAs. The other option is if you own funds, you can choose the income units of the fund as opposed to the accumulation units. Historically, most people buy the accumulation units of funds because this means that all dividends from the underlying companies are accumulated within the fund and increase the number of units you own. However, to reduce risk of any accidental CGT, when investment platforms sell down a portion of your funds to pay the fees, you can potentially switch to the income units. This way, the dividends are paid as cash into your account, and you can use this cash to pay the platform and advisor charges. This option will potentially save you some tax, but the problem is it will reduce the overall long-term growth as you don't get the advantage of the long-term compounding of these extra dividends. So, there you have it. In my view, we do have an unofficial wealth tax in the UK at the moment. If you want help to work out the best way to manage your finances around this, feel free to get in touch through the link in the channel description. See you next time.